You did everything right. You worked 40 years, saved your money, contributed to your 401k, bought the house, played by the rules. But while you were building your life, the largest financial weapon ever created was being assembled in the shadows. It's not aimed at banks. It's not aimed at governments. It's aimed at you. The weapon is invisible. The target is your retirement account, your savings, your home's value, everything you think you own. The timer shows $600 trillion in derivatives exposure spread across 5 American banks. When this bomb explodes, it won't just destroy money. It will delete the concept of money. You won't see it coming. There will be no warning sirens. One morning you'll wake up and the number in your bank account will be the same, but everything you can buy with it will have vanished. The system didn't break. It was designed to break. And your life savings was always the intended casualty. Warren Buffett called derivatives financial weapons of mass destruction in 2002. 22 years later, the weapons factory is still running. The bombs are bigger, the targets are clearer, and the detonation sequence has already begun. $600 trillion. JP Morgan Chase holds $54 trillion in derivatives exposure. Bank of America, $37 trillion. Citigroup, $48 trillion. Goldman Sachs, $51 trillion. These numbers represent notional values, accounting abstractions, until they become real. Here's why notional becomes actual. Counterparty failure. When one player in the derivatives chain collapses, every contract they hold must be settled. The abstractions become bills. The notional becomes demanded. The theoretical becomes your problem. Lehman Brothers proved this in 2008. The bank's balance sheet was $600 billion. But Lehman was counterparty to derivatives contracts worth $35 trillion. When Lehman died, every institution on the other side of those contracts faced immediate demands for settlement. $35 trillion in notional exposure became real losses overnight. Today's exposure is 17 times larger. The mathematics are simple. When JP Morgan's $54 trillion derivatives portfolio unravels, there isn't enough money on earth to cover the settlements. Not enough dollars, not enough euros, not enough yen. The number is larger than the combined economic output of every nation that has ever existed. After 2008, you were told the system was fixed. Dodd-Frank would prevent another crisis. Too big to fail was solved. Banks would never again threaten the global economy. Every word was calculated. Deception. The derivatives market in 2008, $600 trillion. The derivatives market today, still $600 trillion. But the structure has changed. Concentration has increased. Risk has amplified. 5 banks now control what dozens controlled before. Central clearing was the supposed solution. Instead of banks trading derivatives directly with each other, they would trade through clearinghouses. This would reduce systemic risk. The opposite occurred. Central clearing created single points of failure. One clearinghouse failure now brings down every connected institution simultaneously. The banks rebuilt the machine, made it bigger, made it faster, made it more lethal. They convinced regulators that complexity equals safety, that interconnection reduces risk, that too big to fail had become too big to hurt. Derivatives weren't designed to reduce risk. They were designed to concentrate it, to take the risk from thousands of institutions and funnel it into the accounts of regular people who never agreed to bear it. Your retirement account is the final counterparty in a chain of bets you never placed. In 2008, Lehman Brothers collapsed over several months. Bear Stearns took weeks to die. AIG's failure unfolded over days. The next crisis will be measured in minutes. High-frequency algorithms now execute thousands of derivatives trades per second. When the cascade begins, it will propagate through the entire $600 trillion market faster than human reaction time. Central bankers won't have time to coordinate. Politicians won't have time to vote. The system will eat itself before anyone realizes it's starving. The Federal Reserve's tools worked in 2008 because the crisis was slow enough to contain. Interest rates could be cut from 5% to 0%. Trillions could be printed over months. Banks could be nationalized one at a time. The next crisis will outrun every available response. Zero interest rates are already here. The money printer is already running. The Federal Reserve has already fired its ammunition fighting inflation that's barely begun. When $600 trillion in derivatives exposure unravels simultaneously, no central bank on earth has tools powerful enough to stop the cascade. The speed isn't accidental, it's engineered. Algorithms are programmed to exit positions when certain thresholds are breached. Every major bank has automated systems designed to protect them from derivatives losses. When every bank's protection algorithm activates simultaneously, the market dies instantly. Want to know something interesting? Leave a comment below about what you think triggers the final collapse. A specific bank failure, a sovereign default, something else entirely? The trigger matters less than you think, but the patterns are already visible. You think your money is in a savings account? It's not. Your deposits are unsecured loans to banks that use your money as collateral for derivatives trading. When the trading fails, your deposits disappear first. FDIC insurance protects $250,000 per account. The derivatives market is $600 trillion. The FDIC's entire fund contains $100 billion. When the cascade begins, the insurance fund will be depleted in the first hour. Every dollar beyond the initial handful of settlements becomes a loss borne by you. Your retirement account is worse. 401k plans are invested in mutual funds. Mutual funds own bonds. Bonds are debt instruments issued by banks drowning in derivatives exposure. When JP Morgan's derivatives portfolio collapses, every corporate bond they guaranteed becomes worthless. Your retirement account vaporizes with it. Real estate follows the same chain. Housing prices depend on mortgage availability. Mortgages depend on bank liquidity. Bank liquidity depends on derivatives not exploding. When the derivatives market dies, credit dies. When credit dies, real estate prices collapse to levels that make 2008 look optimistic. The stock market amplifies the destruction. When investors realize the banking system is insolvent, they sell everything: stocks, bonds, commodities, real estate. The mass liquidation creates a deflationary cascade where falling prices trigger more selling indefinitely. This isn't speculation. This is arithmetic. $600 trillion in derivatives exposure. $100 trillion in global GDP. The claims exceed the money by a factor of 6. When claims are called, they cannot be paid. Someone loses money. That someone is everyone who thought their wealth was safely stored in the banking system. The 2008 bailout worked because the numbers were manageable. $700 billion in TARP funding. Several trillion in Federal Reserve lending. The global economy could absorb the newly printed money without hyperinflation because other countries needed dollars. $600 trillion is a different magnitude entirely. It's 6 times global GDP. It's more money than has ever existed in human history. Printing that amount wouldn't cause inflation. It would cause the complete breakdown of the monetary system. But the political math has changed more than the economic math. In 2008, Congress approved the bailouts because the public still trusted the system. Banks were seen as victims of a financial crisis, not perpetrators of a financial crime. That trust has been destroyed by 15 years of bailouts, money printing, and inequality. The international math has changed most of all. In 2008, China held $2 trillion in reserves and was happy to absorb American inflation. Today, China is actively working to destroy dollar dominance. They won't subsidize American bailouts. Russia has been expelled from the dollar system entirely. The global reserve currency is becoming a regional currency. Subscribe to understand what comes next. Most channels will tell you the system can be saved, that reforms are possible, that someone smarter than you will fix this. But the mathematics don't allow for salvation. This content exists for the people who want to see clearly while there's still time to prepare. When the derivatives collapse begins, the only response will be to let it burn. Politicians will promise solutions that don't exist. Central bankers will announce programs they can't implement. The system will die because it was always designed to die. Your wealth was always intended as fuel for the fire. The collapse follows a predictable sequence. Stage 1, trigger event. A major bank fails to meet derivatives obligations. The specific cause is irrelevant. Stage 2, cascade effect. Derivatives contracts begin settling simultaneously as counterparty risk spreads through the system. Stage 3. Credit freeze. Banks stop lending to each other as solvency becomes uncertain. Stage 4. Bank runs. As news spreads, depositors attempt to withdraw funds that don't exist in physical form. Stage 5. Government promises. Politicians announce bailout programs that exceed the financial capacity of their governments. Stage 6. Currency collapse. Markets realize that no amount of printed money can solve a $600 trillion problem. The geographic spread follows global financial integration. New York and London die first. Frankfurt and Zurich follow within hours. Tokyo and Hong Kong by day's end. Every financial center connected to the derivatives market becomes infected simultaneously. The contagion doesn't spread. It manifests everywhere at once. The social implications cascade through every institution that depends on credit. Businesses can't make payroll because banks can't process payments. Governments can't provide services because tax collection systems depend on functioning banks. Supply chains break down because trade finance disappears. Modern civilization runs on credit. When credit disappears, civilization regresses to whatever economic activity can function without bank intermediation. Barter systems, local currencies, precious metals. The economy doesn't shrink. It transforms into something unrecognizable. The derivatives bubble shows stress fractures before total failure. Credit default swaps are pricing bank failures at probabilities unseen since 2008. Interest rate derivatives are experiencing unprecedented volatility. Currency derivatives markets are fragmenting as countries abandon dollar-based trade. Regional bank failures are accelerating. These institutions can't handle commercial real estate losses combined with derivatives exposure. Each failure creates counterparty stress for larger banks. The stress accumulates until a major institution breaks under the combined weight. The Federal Reserve's behavior reveals institutional knowledge of the coming crisis. Emergency lending programs are being prepared. Gold purchases by central banks have reached record levels. International coordination meetings are increasing in frequency and decreasing in transparency. Corporate behavior confirms the timeline. Major banks are quietly reducing derivatives exposure where possible, moving operations offshore, increasing cash holdings. They're preparing for something they won't discuss publicly. Their actions speak louder than their earnings calls. The most reliable indicator is mathematical impossibility becoming undeniable. $600 trillion in derivatives exposure, $28 trillion in US GDP. The ratio has reached levels where any significant shock triggers total system failure. We're not predicting collapse. We're waiting for mathematics to assert itself. Rule 1. Exit paper assets immediately. Stocks, bonds, bank deposits, insurance policies. Everything that exists as electronic records in failing institutions. Convert to physical assets before the conversion becomes impossible. Rule 2. Acquire physical precious metals. Gold and silver hold value through currency collapse. 20% of net worth minimum. Take physical possession. Store outside the banking system. Avoid paper claims on metals you don't control. Rule 3. Buy productive real assets. Farmland, rental properties, businesses that generate cash flow without credit dependence. Avoid leverage. Avoid anything that requires bank financing to maintain value. Rule 4. Eliminate debt exposure. Pay off variable rate obligations. Consider strategic default on underwater assets when the system collapses anyway. But maintain fixed rate debt that becomes easier to service as currency devalues. Rule 5. Develop alternative income sources. Skills that remain valuable when complex systems fail. Food production, energy generation, medical care, security services. The economy will reward practical value creation over financial engineering. The preparation timeline is shrinking rapidly. Asset conversion becomes more difficult as more people attempt it simultaneously. Physical precious metals are already experiencing delivery delays. Real estate markets are beginning to price in systemic risk. Move before the crowd realizes it needs to move. After the derivatives collapse, the economy rebuilds around what actually works. Sound money backed by real assets instead of government promises. Local production instead of global supply chains dependent on bank finance. Direct relationships instead of financial intermediation. The transition period will be brutal. Social and political upheaval as existing power structures are destroyed. Economic regression to whatever productivity level can be sustained without credit multiplication. But ultimately, the collapse clears away artificial structures that were preventing real economic progress. New monetary systems will emerge based on hard assets rather than debt instruments. International trade will be conducted through bilateral agreements rather than dollar-denominated contracts. Regional economies will replace global financial integration. The people who survive the transition will be those who understand that the current system was always temporary, that debt-based money creation was always unsustainable, that $600 trillion in derivatives exposure was always impossible to unwind peacefully. The collapse isn't the end of economics. It's the end of financialized economics, the return to production-based wealth instead of speculation-based wealth, the restoration of economic reality after decades of financial abstraction. $600 trillion in derivatives exposure represents the mathematical limit of debt-based monetary systems. The number is too large to bail out, too large to inflate away, too large to ignore. It exists in the global financial system like a tumor that has grown larger than the organism it inhabits. The timeline is compressing because all stabilizing factors are disappearing simultaneously. International cooperation is dissolving. Central bank credibility is exhausted. Public faith in financial institutions is evaporating. The mathematics were always impossible. Now the politics have caught up with the arithmetic. This isn't a prediction. This is a countdown. The derivatives market will collapse because the alternative requires violating basic mathematical principles. The only questions are timing and preparation. Your financial future depends on understanding that the game ended before you knew it had begun. The winners will be those who stopped playing while there was still time to walk away from the table. The timer shows 600 trillion reasons why your money is already gone. The only choice remaining is whether you'll realize it before everyone else does.